Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. If you'd like to know the absolute latest on any commercial real estate related subjects, check out our on-demand show podcast. For example, last week's show was Reese on Real Estate. Reese lead economist Ryan Severino shared their market projections, including how Obamacare and the shutdown showdown could affect jobs and commercial real estate. And check out the show featuring the Fed's view on commercial real estate and the show on tax credits, where we shared ways to reduce tax liability both personally for your business and in real estate ventures. There are lots of interesting shows to choose from. Just grab your phone, tablet, or computer and visit iTunes or the show website, commercialrealestateshow.com. Well, our topic today is corporate office tenant strategies for 2014. Please welcome my guest, Bob Chodos, Principal, Colliers International, Chicago. With a career spanning over 30 years and 13 million square feet, Bob has completed assignments valued at more than $7 billion. Bob has been known to be called the super broker of Chicago. He's also been named chairman of Occupier Services Group of North America for Colliers. Bob, thanks for joining us today.
You're welcome, Michael. Thank you.
And Bob, one of the subjects that's on the mind of people who own, invest in office buildings, and certainly of occupiers and businesses out there, is more efficient use of space. What do you see there for average square footage per employee, and what do you see for the trend there?
Well, the trend is clearly for compression in this area that's happening across all industry sectors. I think if you take a broad view of it, legal per employee, you see somewhere in the 300 square feet per employee, typically something in the 600 to 700 square feet per attorney, if you will, who sits on the window line. Under the corporate kind of operation, you'll see an average of 200, 225, maybe as high as 250 per square feet per employee. And today's more tech-driven environments where you're seeing a lot of use of unique occupancy strategies, sub 200 a square foot. And in organizations like the big advisory firms like a Deloitte or an Ernst & Young or a KPMG, you'll see hoteling deployed very widely, and they're below, using those hoteling strategies, below 150 square feet per employee.
That's interesting. So are they doing that because they're out of the office a lot?
They do, yeah. It's interesting. You'll see one of the largest trends, or most significant trends, driving change in the real estate occupier side of the equation is the fact that at 40 to 50% of the day, seats are unoccupied within almost every office across the country. And CFOs walk around offices and just sort of scratch their head and say, how do we resolve this issue? We have so much capacity underutilized because people are out with clients, or they're out doing research, or they're out on the road doing business and developing relationships. So it's a big question, biggest driver we see in the industry today.
Okay, well, that's interesting. I see the same thing. Sometimes I walk around my office and I see empty, beautiful single occupier offices on glass, and I think the same thing. It's not very efficient. But are employers getting any pushback? Are they having any challenges with less square footage per employee with recruiting or retention or operations at all? Do you hear any of that?
Well, that's a really great question. The fact is that in today's job market, many people are simply thrilled to have a position at all, and if they're they don't look as hard at their physical space as they have in years past. And I will say that companies today are designing space to make it very appealing and the environment to be enticing for the workers, even if it is in a more compressed footprint, because they know that to retain the best and brightest people, they have to offer them amenities. So if the actual seat space or place somebody works is compressing, they're also getting support spaces that they can use where they can have a call room, or they have teaming spaces or lounges, or areas where they can aggregate that are just not at their desk. So there's a lot of trade-off happening, but there is a bunch of pushback on the compression of space and the use of benching and strategies where people are literally sitting across from one another, face-to-face, side-to-side.
So what do you expect moving forward into 2014? You expect to see more compression of space per employee?
I think you're going to see this as an ongoing trend, period.
Okay.
The fact is that real estate is a line item within the cost of a business's operations that everyone's trying to manage and control and reduce, because the cost of space is going up. No matter how markets react over time, the cost to deliver these buildings keeps increasing. So the cost of the real estate itself becomes more and more expensive. So we're going to see companies deploying strategies to reduce footprint on an ongoing basis for years and years to come, cycles to come.
Okay. Well, what about lease terms and clauses? I mean, we went through a tough cycle, and now it's turned around in most markets. In some cases, it's a landlord's market. Are there lease terms and clauses that seem more important to tenants or less important than we've seen in the last few years?
Well, it's interesting. Everyone used to focus on just the rent and on the tenant improvement allowance and the rent abatements and what they could get out of that, and that all those things today are still very, very important. But given the default rate that has occurred with owners of real estate over the past cycle, probably the number one provision we see tenants demanding some level of support on is self-help provisions, the ability to self-help or resolve a landlord default, particularly if there's a monetary event involved. They want the right to offset, to fix the problem, if you will, and offset the cost of that against rent. And you can imagine that is a very hard provision for a lender to swallow if they have not taken possession of an asset and taken deed in lieu, if you will, and wash the owner out of the way. So that's probably the number one thing we see people fighting for. The other areas that that people are paying tremendous attention to are options to terminate, options to contract, expand, right of first offers, and right of first refusals. And the interesting thing is, on these contraction and termination rights, they don't want them to be tied to an all or nothing outcome. They want the right to contract 25% of their space at a given point in time, or terminate 1, 2, 3 floors, all floors of their space at given points downstream in a lease. And so these are very difficult issues for owners to swallow and to, frankly, to finance. But they are things that tenants are focused very heavily on today.
Are you seeing more tenants able to get those today, or is the market firming up a little bit and a little more difficult to get those options to terminate or contract?
It's very market driven.
Okay.
New York, very hard to get a lot of these things. Chicago, a little bit better. San Francisco, tough market to get some of these. It all depends on how tight or loose the market is from a vacancy perspective, and that's a sub-market question in many locations, whether it's a Super A building, A, B, C, near the transportation hubs, away from transportation hubs. Those characteristics will dictate the degree to which an owner will be receptive or recalcitrant in those kinds of negotiations.
That's an excellent point, and we're short on the break. What's the quick answer to FASB? Are you seeing tenants base decisions on FASB where they may have to put their leases on their balance sheet as a liability?
Tenants are looking at it. They're aware of it. We don't see a lot of discussion about it because it hasn't yet come to the fore. People are not. The legislation hasn't really taken effect yet, so people are more focused on things like workplace strategy. And the fact is if they build space, it's so expensive, it's very difficult to do a short-term lease.
Right. Yeah. So the need for space is more important than the accounting. You got to get the business running right. Well, stay with us. More from Bob Chodos. I'm Michael Bull. This is the Commercial Real Estate Show. The Commercial Real Estate Show is brought to you in part by your friends at Bull Realty. When your business requires proven performance, visit bullrealty.com or call 800-408-BULL. Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. We have some great shows coming up for you, including a show on the single-tenant net lease investment market, sometimes referred to as mailbox money. The single-tenant market offers investors a strong, safe return and a great opportunity to lock in the current low interest rates. Don't miss a show of special interest to you. Sign up for a once-a-week email announcing the show topic at the show website, commercialrealestateshow.com. Our topic today is corporate office tenant strategies for 2014. We're talking with Bob Chodos, an office tenant rep with Colliers International Chicago. And Bob, what are the top 3 mistakes that office tenants should avoid in a lease negotiation or a relocation or renewal?
Well, in our business, we often say make sure you get a good advisor to work with you from day one. Companies or people who represent themselves in a process that is complex as a real estate lease and has the far-reaching impact on their business that it can have, they represent themselves. They have, as you know, a fool for a client. So we do advise people to seek out good, quality, trustworthy, forward-thinking real estate advisors who can help them go through the myriad of topics they need to focus on. And that really links to the second issue, which is strategy. Many people will look at the real estate and start going out in the market saying, do I like this, do I like that, what markets do I want to tour? We would say, sit back and say, I have an opportunity to wipe the canvas clean here and do something completely different. And with that as a backdrop, what should I do? And how do I link the changing demographic of my workforce, the technologies that are driving my business, the processes that are in place? How do I create a real estate solution that is going to drive profit into my business? And then the last thing is to link IT, HR, the C-suite, and staff representations in the process early so you can find out what it is really the people that drive your business, what their needs are, and how do you deploy a real estate strategy that meets those needs.
Those are excellent points. It's not just where the CEO lives, right?
It truly is not just where the CEO lives, though we do see that happen from time to time.
Okay. Another important item is timing, isn't it? So the tenant doesn't get behind the 8 ball time-wise. What are some example time frames that corporate users should think about for a renewal or a new space process?
Well, again, that can be driven by the size of facility or the technical aspects of the facility that can influence the timing to get an outcome in place. But generally speaking, minimally 18 months in front of any lease expiry, somebody should be thinking about that. And if you have a termination right in your lease, you should be 18 months in front of that termination right or a contraction right, because those again are events that you can utilize to trigger a negotiation. On a very large lease, anything that might involve the building of a new building, you have to remember that a new building can take upwards of 30 months to build, and then 6 to 9 months to build the tenant improvements in front of it. And then it'll take another year to zone it and get it ready to go. So you can easily, on a large lease, be 5 to 6 years in front of that lease expiry. That's the time frame when you start negotiating whether you might stay and do what we call a blend and extend an existing lease, or relocate to a new development, which is then going to take 3 years to put in place.
Yeah, those are great points, Bob. We see the same thing, that some tenants get started too late, and then they lose the power in negotiations there.
Absolutely.
Well, and you're working all over the country now as chairman of Corporate Services Group there, but you're based in Chicago. Tell us a little bit about the Chicago market and what's the draw to Chicago for corporate users.
Well, one of the great features of Chicago is its employment base. It's got an incredible workforce in the central core marketplace and surrounding regional market. It's a 350 million square foot plus market. Downtown market's 144 million square feet. We have some of the top universities in the United States located within our marketplace, and so we're able to really offer an incredible workforce. And our market as a whole has gone through a real rejuvenation of the downtown core with the development of Millennium Park and the creation of boulevards and landscaping and a 24-hour city. So people are moving back into the core of Chicago because it's such a great place to live. Vacancy in our market today is sub 11-12% across the market, but in the Class A high-rise view corridors, we're sub 5 and 4%. So it's a market that didn't go off the edge of the cliff, if you will, when we went through the financial crisis, and we were not overbuilt and new buildings weren't happening. The first new building coming out of the ground today is a new building at River Point in Chicago that Hines is developing. It's a 47-story new high-rise. That's the first building since 2009 deliveries that were incepted in 2005. So you can see it's been a long cycle in the market, but overall very healthy.
Okay. Well, Bob, thanks for sharing your wisdom with our listeners today. We sure appreciate your time.
I appreciate it. Thanks, Michael.
If you'd like more information from Bob Chodos, visit commercialrealestateshow.com. We have his information there for you. And stay tuned. We're going to have more intel on office tenant strategies, including more about timing and more about some other strategies involving your lease. I'm Michael Bull, and you're listening to the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by your friends at Bull Realty, France Media, Atlanta Office Liquidators, and Wiseman, Nowak, Curry, and Wilco. For more information about these companies or to access additional show podcasts, videos, or blogs, visit commercialrealestateshow.com.